So welcome to yet another amazing session on CA final financial reporting, where we are going to revise our lovey-dovey cutie Ind AS 1. This revision is going to be in 100% English for my lovey-dovey students who are more comfortable with English, right? Acha, in this revision, I will revise all the concepts and the relevant important questions. I will also revise, but yes, do self-revise it as well. Also, if you are watching this on YouTube and if you are watching without subscribing, no, first subscribe and then watch. Okay, apart from this, if you like, do consider liking the video, and I will upload the board notes which I use normally in my video on my Telegram channel. So you can join. It is your Telegram channel only, so you can join from the description box. You can find the relevant notes as well. Chalo. So let's start the revision in 3, 2, 1 and go. First of all, the number is Ind AS 1, name, presentation of financial statements. So first point is scope. It applies to SFS and CFS. Okay, does not apply to interim financial statement because there is a separate Ind AS for this, Ind AS 34. Anyways, remaining you can read. Then second point is complete set of FS. When I say that I want to prepare a complete set of financial statements, what all come in the complete set of financial statements? So in case you remember, I made it right also. There are total 7 items. Out of the 7 elements, the first 6 are compulsory to be prepared every year. What are those? Balance sheet, profit and loss, statement of changes in equity, cash flow statement, notes to accounts, and of all these 5, you have to give 1 year comparatives. So these 6 are compulsory. Now 7th, we prepare only in certain cases. What is 7th point? Opening balance sheet on day 1 of previous year. When do we prepare this? We prepare this only when we are giving any retrospective effect of maybe a change in accounting policy, maybe a rectifying an error, maybe rectifying a classification error. So in these cases, we give the effect retrospectively. So in these cases, we have to prepare current year balance sheet, previous year balance sheet, along with previous year. One more balance sheet known as opening balance sheet, on which date it will be prepared? On first day of previous year. So previous year's first day. Okay. Detailed discussion of this happens in Ind AS 8 as well. Anyways, then all of these complete set, we start discussing about each one of them. The first point is balance sheet. So in balance sheet, the major classification of current and non-current, right? Because in asset also we have to show current, non-current. In liability also we have to show current, non-current. So first we will go through a definition of current asset. So there are how many conditions? There are 4 conditions. We have to meet any one. If any one is met, it will be current. What are those 4 conditions? First, if it is expected to be realized within normal operating cycle, then current. Second, if it is expected to be realized within 12 months from the end of reporting period, then current. Third, if it is held for trading, for example, inventories. If you trade in derivatives, then derivative financial asset, current. Fourth, if it is cash and cash equivalent as per Ind AS 7. So what is cash and cash equivalent? If you have cash balance, it is current. If you have bank balance, so bank balance of less than 3 months, maturity of less than 3 months are covered in cash and cash equivalent. Those are CC, classified under current. So if you have a fixed deposit of less than 3 months, it will be CC. If you have a FD of more than 3 months, it won't be CC. CC means CC, cash and cash equivalent. But for extra clarity, I told you, if you have a FD of let's say 6 months, it won't come under CC. But still this FD is a current asset. Why? Because it can be current as per the above conditions. No? Do remember. So if you have a cash and cash equivalent, it is a current asset. But if there is a restriction on this CC, and the restriction is of more than 12 months, then it will be non-current. For example, remember Vijay Kalia savings account getting freezed for 3 years. So savings account is normally CC, but because we have ceased for a period of 3 years, it will be non-current. Do remember. Acha. Similarly, we were given the definition of current liability also. Acha, what is non-current asset? Whatever is not falling above will come under non-current. Acha. Current liability. Again 4 conditions, but here instead of expected, check for the word due. In the first point, as per Barrett, it is expected, but in exam, as per ICAS solution, they check for the word due only. Okay, anyways. So current liability, again, 4 conditions we have to meet anyone. First is settled in normal operating cycle. Second is due to be settled in 12 months from the end of reporting period. Third is if it is held for trading. Okay. Sir, how can a liability be held for trading? If you trade in derivatives, then derivative financial liability can be there. Acha, 4th point. Now to understand 4th point, do you remember I gave you an example for this? See, have a look here. Let's say I took a loan from Hema, okay, which is due within 12 months from the end of reporting period. So it is normally current, but Hema, being a nice person, gave me an unconditional right to defer the payment for 2 years. If AK has such right, can I say the loan will be non-current? Because now AK will make the payment after 2 years. But if AK does not have such deferment right, if AK did not have any such deferment right, can I say the loan would have been current only? So it is written here. If you do not have, if it does not have an unconditional right to defer the settlement, then it will be current. Simple, right? Okay. Then all other cases, it will be non-current. Then we discuss the concept of breach. Now under breach, do you remember my summary chart which I gave you? I gave you the examples also. Just go through them once. But I gave you a summary chart also. For breach of long-term loan arrangement, if you take a long-term loan and you breach it, so just check if after the breach, once you breach, it becomes current, the loan becomes current liability. Then after the breach, you obtain a grace period. If the grace period is of less than 12 months, the loan stays at current only. If after the breach, you obtain a grace of exact 12 months or more than 12 months, then the loan will again become non-current. Acha. What if for a long-term loan, before breach only, you did not let the breach happen. Before the breach, you got the compliance date extended. You might extend for 3 months, 6 months, 12 months, whatever. But you did not let the breach happen. Before breach only, you went and got the compliance date extended. In that case, can I say till year end, you avoided a default? Before default only got the date extended. So if before the default, you extend the date, then as on year end, the default has not happened. So the loan retains its original classification of being non-current. To explain this better, I have given some examples. Please go through them. Okay, being a revision video, I'm focusing more on revision. Anyways, okay. Then this was regarding the balance sheet aspect. Then there are certain more points. I will just rush through other points, but rest assured, till what I revised now conceptual, that is more important. The remaining points, just rush through things quickly. Then we talk about profit and loss prepared as per schedule 3, 2 sections, P&L and OCI. Total of this is TCI. Okay. Then statement of changes in equity. So it is nothing basically but a reconciliation of opening and closing balance of all items of equity. Then cash flow prepared as per Ind AS 7. Notes. Whatever you prepare in balance sheet, P&L, cash flow, give disclosure in notes to accounts. Then there are general features of financial statements. How many features? 8 features. Don't ratify them. Just refer and move forward. First, presentation of true and fair view. So they say whenever you comply with Ind AS, we assume you are presenting true and fair view. Also, whenever you comply with Ind AS, you can make a explicit and unreserved statement of compliance with such Ind AS. Acha. Disclosure is not a remedy of wrong accounting. If you do anything wrong, just by disclosing it, you can't say that we have rectified the error. Okay. Also, one note is given. For example, let's say auditor feels that company has not complied with all the Ind ASs, but management feels that they have complied with all the Ind ASs. In that case, whether management can put explicit and unreserved statement of compliance, the answer is yes. Why? If auditor has problem, he will qualify his audit report. Okay, do remember that part. Acha. Then next point is departure from requirements of Ind AS, whether permissible. Can you deviate from the requirements of Ind AS? So they say you should ask a regulatory framework. If your regulatory framework allows the deviation, you can deviate. If regulatory framework does not allow the deviation, you cannot deviate. Disclosure is required in both these cases. Okay. Then going concern. 3 points are there. If going concern is valid, very good. If going concern is not valid, you have to do 2 things. First, the basis of preparation will no more be accrual basis. It will change to liquidation or realization basis. And you have to give the reason why the going concern is not valid. Third point, if there is a doubt on going concern, in that case, just disclose the uncertainties. Okay. Okay. Next point, accrual. All financial statements are prepared on accrual basis except for cash flow statement. Materiality. All material items are disclosed separately. All immaterial items can be aggregated together. Acha. In certain cases, even if an item is immaterial, you might show it separately, maybe because it is a requirement of law. Example, CSR expenditure. Offsetting. Until and unless Ind AS permits offsetting, you will not offset any asset liability. Also, just apply some common sense here. If there are same parties involved for whom you have sold something and you have purchased something, so if same parties are involved, you can offset, of course. So apply some common sense also here. Anyways, 6th point, consistency. Whatever you follow in balance sheet, presentation, policies, classification, apply it consistently. Of course, you can change under exceptional circumstances, but to the extent possible, apply it consistently. Frequency of reporting. How frequently you have to submit the annual financial statements? Once in a year, annually. Comparative information. How many years comparative is to be given? Minimum 1 year. Acha. If you are preparing that opening balance sheet, in that case, balance sheet will be 3 columns. Previous year, current year, previous year, opening balance sheet. All other will be only current or previous year. All other elements will be current or previous year. Acha. If the company wants to give additional comparative information, can they do so? The answer is yes. They may give for more than 1 year comparative as well. Last point we will discuss in Ind AS 10. This was the revision of your concepts of Ind AS 1. Now let's jump on towards the questions very quickly. We will take the tricky questions first. First is illustration number 11. So there are 3 items given. They want us to classify whether they are current or non-current. So first is deposit of electricity. When you get a connection done of electricity, so normally you will keep the connection for a certain number of years. So this deposit is non-current. Tender deposit money. So whenever you are not sure, give a diplomatic answer. If you feel that you will receive the deposit in 12 months, then current, otherwise non-current. Same is for the third case. Give diplomatic answer. Then illustration number 13, a good question. You have an existing loan of 9 months, okay, but you got a rollover facility of 5 years. That means you got an unconditional right to defer the payment for 5 years. So how will the loan be classified? Non-current. But will the answer be different if the new facility is after the reporting period? That means if this rollover is after given to you in the next year, so in the current year the loan will be current only. Next, will the answer to A be different if existing facility is from one bank and new facility is from another bank? That means this loan of 9 months is from one bank and this extension of 5 years is given by another bank. So can I say the existing loan will be current only? Okay. Fourth, will the answer to A be different if the new facility is not yet tied up? If we have not tied up this facility, the loan will be current. Potential is of no concern for us. Do remember. Done. 14th illustration is very simple. It says that we have taken a long-term loan and there is a condition that promoters also have to contribute by 24th March. Now what happens is promoters defaulted and they obtained a grace of only 3 months in this case. So if after default you take a grace of less than 12 months, the loan will be current. Second case, let's say in anticipation of the default, before default only, they went and got the date extended. Now till year end there is no default. So the loan will be non-current. Already discussed this. Okay. Then there are certain questions which are common pool. See, when I teach, now I mark some as common pool. Maybe these are important, but common pool means this I will cover when that relevant Ind AS is taught to you. Okay. So do remember that part. In case if you are not studying from me, that is fine. Okay. 21 you can just give a read. Okay. I'm not revising, just give it a read. Same for 24, just give it a read. Similar question, I will take a better one of it. Okay. 25 also just give it a read. Offsetting provision, just give it a read. Okay. Question number 1. So again, we have to classify whether current or non-current. So for receivables, so normally receivables fall due within operating cycle, so current. Advance to suppliers, again they will fall due within operating cycle, current. Income tax receivable, give diplomatic answer. If receivable within 12 months, then current, otherwise non-current. Insurance spares, so this is linked to Ind AS 16 now. So for spares, in Ind AS 16 we read one point. If definition of PP is met, then spares will be non-current. If definition is not met, then it will meet the definition of inventory. Then inventory is always current. Do remember that. Done. Then there is question number 2, a very good question. Just have a look at it. It says that we took a long-term loan, but there is a condition to maintain debt equity ratio. Let's say case number 1. We are not in breach of any convenience. If we did not breach, then the loan will be non-current. Achha. Second case, we breached. In second case, we breached, but grace period is of exact 12 months. When you get the grace period of exact 12 months, treat it like more than 12 months. The loan will be non-current. Case 3, we breached, but we did not take any grace period. So loan will be current. Third. Then the question number 3, a very good question, please remember. Operating cycle, 15 months. It says we gave a deposit. So giving a deposit is an asset for us because in future we will get the refund. So this deposit out of 2 CR, 70% of 1.4 CR is receivable in 14 months. It is said that it is receivable in 14 months. That is within cycle of operating. So current. Rest 30% you will receive after 17 months. So this is out of operating cycle. So non-current. Achha. Second point. There is a trade receivable which you expect to receive within cycle 14 months. So current. Okay. Third case. Do you remember third case I discussed with you? When you receive a deposit like a liability for you, and if this deposit is cancelable, and on cancellation you have to give the refund immediately, then the full liability will be current, irrespective of any other conditions. Remember, no? Yes. We discussed this specially. And the fourth point, whenever you give a capital advance for purchasing a machinery, does not matter when the machinery gets delivered. It is a capital advance. Capital advance for purchase of machinery is always non-current. Acha. On the other hand, when you sell a machinery, you are about to receive some money on sale. This is a receivable. On sale of machinery, the amount which you are going to receive, don't check capital or not in this case. For a receivable, check the normal conditions. If they are due within 12 months or due within operating cycle, then it will be current. Do remember that part. So a good question again. Then remaining questions, I guess it is fine. Just give all the remaining questions, just give them a read. And with this, we have completed a good revision of IND AS 1 as well. I hope you like the revision. My main motive here is to revise things quickly, so that if you would have taken time to revise IND AS 1, it would have taken maybe 1 or 2 hours. With me, you can revise the same in 15, 20 minutes, and just put in that extra 30 minutes to revise the questions on your own. You are done, you are through. So you will save a lot of time using my revisions. Okay, so if you like it, do share it with your friends, because sharing is caring. On that note, thank you so much. I hope you like it. Bye bye everyone. Take care. See you all.